Hey everybody, good morning. Actually, it says live from Rye, New York. I'm absolutely not in Rye, New York. I am this morning in Chicago, at the Peninsula Hotel right now. So hi everybody. And I am it's been a while and I'm happy to be here with you today. Yeah, and I have a very special guest with me, which I will tell you a little bit about. Steve, we've had before, some of you that attended our dinners, and Joe. And we will be talking about opportunities, a very interesting strategy of investing around the legal world. We'll talk about it in a second. And this is being recorded, as you well know, and will be shared with those who couldn't attend and those who could attend. So so you can all view this later as well. So good morning, Steve. Steve, I believe you're in Connecticut area, right? In New York. And Joe, are you in Chicago?
Yes.
Great. Great. So
I'm outside of New York, Danny.
Outside of New York. Great. Good morning.
Good morning.
Couple of words. Steve is the CIO of Air Asset Management that, again, as I mentioned, have been with us before. Steve is responsible for managing the portfolio team and overseeing the investment and risk management at Air. He plays a critical role in developing and executing strategic initiatives, structuring and launching new investment products, and interfacing with investors. Before that, it was with Peregrine Asset Management, ran Columbus Global Advisors, a commodity trading advisor and commodity pool operator, and was VP of Capital Markets at BNP. Joe. So Joe is the CEO, CIO, and founder of Kerberos Capital Management, responsible for ensuring the adherence to its core investment philosophies, communicating closely with clients on products and strategies, and overseeing operations. Before that, he was a nationally recognized attorney. He was named to the Law Dragon 500. That's a scary name, Lord Dragon. Respectively named a super lawyer and leading lawyer for litigation, class actions, and mass torts practices. Was listed in America's top 100 attorneys, and holds an AV permanent rating by Martindale Hubbell, the highest possible peer review. Amazing. Thank you both for being with us here this morning. And you know, we talked about it before, Joe. What you guys do is interesting, and I don't see many that do that. And I see many, you know, hundreds of presenters in a year, and investment opportunities. And what you're doing is a very interesting strategy in a very interesting world that is pretty, I believe, resilient to the trends in the economy, which makes it even more interesting these days. So first, I'll ask Steve, maybe we'll start with you to give us a little bit of background beyond what I've mentioned about you and Air. And then we'll go and dive into what he does.
Yeah, no, exactly. Denny, thank you very much. And thank you everyone this morning who is attending. I'll give a little background on Air, and then we'll move right into the focus of today's webinar. Air Asset Management is a registered investment advisor. We have approximately 650 million in assets under management, and our key strategy is a strategy with 500 million in assets under management, and it's called Air US Life Fund 2. Its core focus is longevity related assets. So we construct portfolios that are built around insurance policies, life insurance policies, as well as investing in structured settlements that are life contingent. So we have a life contingent or a mortality or a longevity theme to the assets that we invest in. We also, though, have a private credit sleeve, and we feel that private credit is very important as a complementary generator of returns to the types of returns that we see in the longevity space. And not only do we lend directly, opportunistically within our private credit sleeve, but we also partner from time to time with experts in particular niche areas. And we have been fortunate enough to know Kerberos now for several years. And the strategy that Kerberos employs is something that complements our overall strategic asset allocation beautifully. And in a way is actually a form of integration, since we buy life contingent annuities, which are post-court structured settlements. Gaining access to private credit opportunities within the litigation or law firm lending space actually allows us to take advantage of returns that are generated prior to settlement. So it works very well from a thematic point of view in our overall allocation. And to this extent, we allocate through our private credit sleeve and have created a sub-fund of Air US Life Fund 2, which is dedicated solely to law firm lending, and of which Kerberos is the sub-advisor. And that fund is called Air Legal Finance Fund. And we look for, through Kerberos and through their expertise, and Joe will speak in a second, I don't want to take up too much more time, but we really look to direct investments through loan participations to law firms. And the overall profile of the lending is a little bit different than what most people consider standard litigation finance. So with that, I'll turn it over to Joe and let Joe talk a bit about some of the background on Kerberos and so on. Thanks, Joe.
Yep, thanks, Steve and Denny. I'll just jump right in. So as Denny mentioned, I'm a recovering lawyer. We founded Kerberos 5 years ago now with an initial specialty or flagship strategy in litigation finance. Although, as we'll talk about today, we're sort of set up institutionally like a private credit platform. And in many ways, the way we operate is the way that you might expect a traditional sort of direct lender to operate. It just so happens that we're operating in a very specialized and unique asset class that allows us to do some pretty, I think, compelling things on a risk-adjusted basis. So that's just by way of background. Maybe the place to start, Steve and Denny, is just sort of, what is the appeal, what is the value proposition of litigation finance, and in particular, law firm lending?
Please.
Finance, I would say it's as a sort of preliminary point, it's important to understand what is meant by litigation finance. And oftentimes people who are newer to the asset class, investors who are trying to do work on the asset class and figure out where an entry point might be, one of the hardest things to understand is what exactly is litigation finance, because the term is used very inconsistently in the mainstream media, for example. There are, if you read in the Wall Street Journal, for example, every time that litigation finance is mentioned, invariably what they're talking about is the financing of a specific case against a specific company, in which you're basically taking equity risk on the outcome of that case. So the role of a financier in those circumstances is to say, we'll give you $1 million of equity capital to finance this case. If it's successful, we'll get a return of 3x or 4x or whatever. And if we're unsuccessful, then we'll get a return of 0. And you do that 20 times throughout the fund and hope that you hit a few home runs and don't have too many goose eggs. That is not what we do. In fact, what we do could best be described as the polar opposite of that. We don't like taking any kind of equity risk or binary risk. And really, therefore, the essence of our strategy is capturing equity-like returns, despite the fact that we're only taking credit risk. That's really what we're trying to do. And the way that we do that is not by betting on case outcomes, but by providing capital to law firms, lending to law firms on a basis in which the entirety of their collateral pool is crossed and we're first priority senior secured on their caseload. So what that means is that we're able to charge them a very high interest rate because of the complexity of the collateral. But at the same time, we're not betting on case outcomes. If a case here or there goes poorly, they still owe the money, and we're still very well protected because we're crossed against hundreds of other cases, more typically thousands of cases, just for one individual loan. So let me just pause there for a moment and see if there's follow-up. But I think that's kind of like a basic step one in approaching this asset class.
And I wanted to ask you about, to dive more into this, about what makes this, litigation finance, or more specifically law firm lending, an attractive solution for today's investor. Now, I mentioned the uncorrelation to the market, which is very important at times like this, where basically wherever you go, you're basically losing money in traditional asset classes, or at least the risk is still there. So uncorrelation is very important. But if you can talk about, the entire, why you see that as an important place to go in today's environment.
Yeah, I mean, uncorrelated performance is of course at the very top of the list, and that's one of the key benefits of investing in this asset class. In fact, you can make the argument that with our strategy, it's almost counter-cyclical in that when the sort of world is falling apart, right, and global macroeconomic conditions are trending poorly, that tends to result in more litigation across the board, and then that creates more demand for our product and so on and so forth. So, uncorrelated is definitely one of the key benefits. The other thing is that we have significant collateral protection. I mean, it is arguable that one of the best ways to look at our particular strategy is that we're more like an asset-based lender, and the assets are, of course, the cases, right? So it's not really like cash flow-based lending, where we're lending against receivables and trying to sort of project revenue over a 6-month, year and a half period, whatever it is. I mean, there is some of that, but fundamentally, even before we get to cash flow, what we're doing is basically collateralizing cases. And in that way, we're getting many of the benefits of asset-based lending, despite the fact that we're still charging, sort of equity-like returns or equity-like pricing for the capital. I mean, typically, when we put money out, the returns or the product is priced anywhere from 15% to 25%. And so, that's unusual for asset-based lending, of course. So on a risk-adjusted basis, to be able to get those kind of returns, despite taking, credit-like risk with, an asset-based approach, is very unusual. And it's really the confluence of those factors, I think, that makes this appealing to investors.
Joe, I just want to follow up on that. You mentioned something, there was this risk-adjusted return. So, like, from our perspective, right, in our allocation to you guys, we look at it and we, in the totality of the lending universe. And what we see here is, fairly short duration assets. You see loan to value, which is very strong. In other words, the level of collateralization to the risk put out has a very, very good profile to it. And then, of course, the return aspect to it, vis-a-vis the shorter duration, the really good collateralization, the coupon, okay, for what is essentially this form of working capital financing, as you were saying, as opposed to this long-term, cash flow-based lending. And it's very interesting because it takes a certain expertise to really do the credit analysis and understand the underlying risk. And it doesn't seem like, the banks don't seem to be in there because they don't have the expertise. Maybe you could talk about that a little bit, because it's that kind of expertise which ends up translating directly in the type of return profile that we see here.
Yeah, that's exactly right. That's a really important point. I mean, that's basically why there's a complexity premium for the work that we're doing. I mean, so, a sort of typical scenario for where we're lending against, just to illustrate your point, Steve, would be, a law firm that walks into a bank, let's say, with 1,000 cases, and they're all on contingency, and they're all legitimately very good cases where they've all, let's say, eclipsed the point of any kind of binary risk to the cases themselves. It's not a question of whether, it's a question of how much and when, let's say in this example. But because of the carrying costs of the collateral and the fact that the cases take a 2 or a 3 year period to really monetize, if they walk into a bank, the story might be, look, we lost money this year, and we're probably going to lose money next year. But the year after that, all these cases are going to come in, and the cases are wonderful, and we're going to make a lot of money. If you walk into a bank with that story, they're going to look at you like you've got 3 heads, right? You're not going to get very far. And so what we do is we essentially come in and say, yeah, we get it. This is exactly right. Like, the cases themselves are excellent cases. We understand this collateral very well. We're very familiar with this. We have lots of data on these cases. There's lots of precedents. There's settlements for the cases of this type that we know what the market value is for those. We can run the data and we can come up with a valuation against which we lend a very conservative amount. And yet, over the next 12 months, they may not have a dime of revenue. That's exactly what the investment thesis is. It's like a bridge loan, basically. And so there are only a handful of people in the country who can probably underwrite a situation like that, because unless you happen to have specialized expertise, there's no reason why anyone else would be able to make heads or tails of that stuff in any meaningful way. And so that's really what we're doing, is charging capital, 20% pricing, 18, 22, whatever it is. We're charging a price for capital that is disproportionate to the actual risk, just given the market conditions and the complexity.
Yeah, and just to pick up on that, we've seen other folks in the space, right? And one of the things that I find so compelling, okay, about your approach, which is based on expertise, it has to be, you guys are all lawyers and so on and so forth. But what I find so compelling is the process of arriving at a decision to go ahead and lend, essentially, and the different steps and the categorization of probability of outcome in terms of particular cases. In lending to one law firm, you'll have different probability assessments on a whole slew of cases and so on and so forth. And do you want to talk a little bit about that process? Because I find that extremely compelling and very, very specific and clear.
Yeah, it's the best way perhaps to look at our underwriting process is that it has 2 silos, the collateral silo and then the traditional credit silo. Mm-hmm. So in the collateral silo, what we essentially do is we try to arrive at a valuation in terms of net attorney fees payable to our counterparty, our borrower. And then we lend a very conservative amount against that number. So the way that we arrive at the number is by basically bucketing the cases by maturity. That's first and foremost. So if there's 100 cases in the portfolio and 25 of them were filed yesterday, let's say, those cases are basically just discarded right off the bat, because we're not taking binary risk on those cases. We're not in the business of betting on case outcomes. So if it's that early, then there's just still too much risk attached to the cases. Now, there might be 75 left where, let's say they're on the spectrum, they range from settled money good to they've eclipsed summary judgment, or they have a summary judgment ruling in their favor on liability, and they just need to establish damages or whatever it may be. On that spectrum, we can begin to assign very meaningful valuations with a very tangible sort of risk variable attached to it that allows us to figure out, what the real risk of the portfolio is, and generally, what the value is. The timing is also very important, by the way, because the same dollar tomorrow is a lot different than the same dollar, 5 years from now, right? So figuring out when the cases come in is a very important part of the process, perhaps actually the most important and most difficult part of the process. But that's all what goes into that, collateral silo. We've been doing this for a very long time, and we have a lot of specialized expertise that allows us to do what would be impossible for a lot of other folks. it's a delicate balance, right? Because you want to go deep on these things, but you also want to close a transaction in a commercially feasible time frame. And there aren't that many people who can sort of, walk that line, which we're proud of. And the credit silo, we're looking at a lot of the traditional sort of credit metrics. We need to understand what the liquidity picture is going to be. How much cash does it take to operate this place? What is the cash flow going to look like over the next year, et cetera? How much money are we putting onto their balance sheet? And is that enough? Basically, what we're trying to solve for, Steve, is we don't want to be in a situation where we give someone X million dollars of capital and then they just blow through it. And then in 6 months later, they come back and they need more to make payroll. And then we say, well, geez, now there's not enough coverage to make this additional loan comfortably. We front load that analysis and we have all of that built into the cake, basically. And sometimes the loan doesn't work at that point, right? And so we are digging deep on all those, and only when all the boxes are checked can we get in.
And yeah, sorry, Steve, you wanted to add anything?
Yeah, no. Go ahead, Denny.
Yeah. Okay. So I wanted to talk about what's other elements that are very interesting to explore, which is how your team and strategy is unique in the litigation finance space. If you can talk a little bit more about lending versus single case funding, a little bit more to dive into the industry risk and all of that side.
Yeah, so I think one of our primary differentiating factors is the strategy itself. We talked earlier about how there are different verticals within litigation finance, and a vertical that you don't see as much, certainly, is the law firm lending vertical. When we started, I think we were one of truly a handful of people in the United States who did that stuff. We were one of the early pioneers. Since that time, I've seen other people come in and then come out. And so on any given day, it's less clear how many people are doing this, but the answer is still not that many compared to the predominant equity type strategy. The reason I think that more people don't do what we do is because it's actually very hard to build the right kind of platform that one needs to do lending. When you do the sort of betting on cases strategy, what you have to do is basically just price the investment correctly and structure it correctly. But once the money's out, I mean, that's pretty much it. Like, you hope for a good outcome. You don't really have ongoing servicing responsibilities. Whereas with a loan, it's entirely different. When you make a loan, I mean, the transaction is really just beginning when you provide the capital, and then you have to live with it, right? And monitor it and service it. And the necessity of an institutional grade platform for that type of strategy is paramount. And as we all appreciate, that's not easily built, right? And so I think one of the reasons why a lot of ex-lawyers migrate into the space and get into the betting on cases stuff is because the barriers to entry are much lower. To do what we do, you have to have the right platform, and that's not easily accomplished. But we've done it, and we're doing it, and so that's why we continue, I think, to be successful with the lending strategy.
Yeah, and just to follow up, I mean, it's really a combination of having very, very honed credit skills as well as having that legal expertise. I mean, both of those things really, really coming together. You talked about the difference between the sort of binary outcome in a case-specific type of financing versus actually lending, making loans. Once that loan is out there, talk a little bit, if you can, Joe, talk a little bit about sort of just the process of managing risk. Once the loan is underwritten, how do you guys look at that? How do you mitigate the risk on an ongoing basis? Some of those aspects, which really are key to the post-transaction process.
Yeah, so as with the underwriting, the servicing itself really has the same two components, the sort of collateral component and then the credit component. So every month, we're doing a number of things. We are policing the operating account first and foremost, right? We get copies of the bank statements or real-time access to the bank accounts, which is incredibly important so we can monitor the cash in and the cash out. Monitoring the cash in is important so that we can tie out the collateral monetization process with the actual cash coming in to make sure that we're getting the right amount remitted to us as part of the debt service on the loan. So because typically we set it up with PIK interest and event-based recapture. not a coupon payment. So the amount that is owed is tied to what comes in. So we're very, very invested in that. The other reason why that's important too, to monitor the bank accounts, is because we have a variety of covenants that are usually, not usually, always baked into the cake when we structure the deal. So for example, when we underwrite a loan, typically there are going to be not assumptions, but there's going to be a thesis about what the operating picture looks like. We're going to create an operating budget and say, this is what the annual spend is going to be, and here's where the money is going to go. And on that basis, we have a cash flow model that looks in a certain way, right? So that does you no good if the day after the loan is given and the capital is out. It's just, there's a dividend or something like that that basically causes significant leakage, right? So all the underwriting assumptions would be busted. Mm-hmm. So of course we have to prevent that and protect against that. And the way that we do that is by building in a variety of covenants that relate to the spend, owner compensation, discretionary spend, et cetera, et cetera. And at the risk of oversimplifying, needless to say, we have very significant protections and very significant rights. So the cash flow monitoring process is designed to make us ensure that the covenants are in compliance, and also to make sure that there's good liquidity at the firm, or there continues to be good liquidity. If there's a critique that I would levy against many law firms generally, it's that lawyers sometimes can make very poor business people. That's like the old saying, right? And so one of the value propositions for us is that we can really introduce some discipline into the operating picture, almost in the way that a private equity company might, sort of beef up the infrastructure of one of their portfolio companies. Mm-hmm. Same idea. We can really help them with that. And so there's an ongoing dialogue, let's say, on a monthly basis related to all those things. Then on the collateral picture, we are monitoring the progression of the cases themselves. We get very significant reporting from the firms that leads to a dialogue every quarter where we basically re-underwrite the whole portfolio. We also have our own independent docket tracking mechanisms so that we're not reliant on what the firms are telling us, but they all are basically providing data to us. And basically what we're trying to do is every quarter come to a new valuation of the collateral. It does us no good to tell our IC that a loan has 25% LTV today if 6 months from now the LTV is now 75%, and then no one knows that because people stop paying attention. Like, that is fundamentally contrary to how we approach these loans. We re-underwrite them every quarter so that at any given moment we know where the loan is at. And if we feel like a loan is trending in the wrong direction from a coverage standpoint, there are lots of things that we can do to improve that picture.
And I think that's a key point. And I think that's actually a distinguishing feature, is the fact that, there's a look every 90 days at essentially the quality of the collateral and a re-underwriting of it, which is so key because it just keeps you on top of the collateral base and constantly looking at value.
Yeah, that's right. And that's super important because, in a direct lending strategy, the critique that I have heard investors and other funds give is that they don't really know where they're at, right? Because the manager will send you a report saying, no one's in default, and we're getting a blended average return on the portfolio of 20%. And so you get that report and you think, well, this sounds like it's going great. But what you might not know or might not be told is that half of the portfolio have loans that are almost underwater, right? And so if you knew that, you probably feel a little bit differently, and that might cause you to take various actions on your end. And so our philosophy, this is somewhat of a digression from your original question, but our philosophy is to be utterly and completely transparent at all times about where all the loans are at, so that investors can see really what's going on. And that's just sort of baked into who we are and what we do. But I think one of the benefits is that investors feel comfortable that they really do know what's going on. There's no mystery to where the position is at.
And why do you think the opportunity even exists, actually, when we think about it?
Why does the opportunity for the direct lending strategy exist? I think much of it relates to the complexity of the collateral point. I mean, to put it a different way, there are many law firms out there that will never need to do business with us. It just wouldn't make sense. And frankly, that's most of them. If you're a traditional type law firm, like a corporate law firm that many of the people on this webinar, for example, use for their offices, If you're a traditional law firm that bills by the hour, and every 3 minutes when you're on a phone call with someone, then you bill like in tenths of an hour or whatever, and then the clients get the bill and say, why did it take so long for this? And then if you're a law firm that does that, you don't need to do business with Kerberos because you've got recurring cash flow and there's no real inventory that you need to support, right? And so if you went to a bank to borrow money, it might be for an expansion or something, but you would have a balance sheet and you would have cash flow. It would be a traditional loan for the bank. You wouldn't need to pay Kerberos 15%. Now, if you are a law firm that operates primarily on a contingent fee basis, where you're not charging people by the hour, you're taking very high risk, very high reward cases on a contingent basis, and you have a portfolio of them, that's the kind of person that needs some kind of like cash flow management tool, because it's a very, very dangerous, if not impossible game to have no line of sight onto when things monetize, but then you've got payroll or rent due next week, right? And so what we're really doing is giving liquidity solutions to law firms who are in that situation. And a bank can't do it because a bank would have to understand the collateral, which of course they're not in the business of doing.
And basically, you obviously coming from the legal world, you have the knowledge, you've been there in the ins and outs to really look at the deals that these guys have been taking on, judge the risk and their chances to actually get the returns back in house, and do your due diligence on these guys really, and find out who's a really good opportunity to work with and who you should avoid.
Yeah, that's right. The operating picture of the firm and sort of the track record type diligence is also, a very important part of the process. So what we like to do is lend to firms that are as institutional grade as we can find them, I guess is one way to put it, right? So, a law firm that's like a solo practitioner, and he's got a handful of cases. It's basically him and a secretary inside a shoebox. That's probably not a great loan for us, right? Because there's key man risk attached to that. If he gets hit by a bus, then who's going to handle the cases? The back office is probably very poorly designed. That's not a situation that we'd be keen to invest in. A much better situation would be a law firm that has a lengthy track record of success with the types of collateral that we're lending against, and that has numerous other handling attorneys running the cases, so that if any one of them, including the principal, got hit by a bus, the firm would be able to keep the cases going without too much disruption. And the back office is pretty institutional, at least by law firm standards, which means they've got, a CFO or an accounting department. They've got some admin people back there, and they're able to respond to information requests quickly. That's very helpful. The most important thing, or I would say as important as any, is the diversity and volume of the portfolio itself. So if a law firm has 10 cases, let's say that it's like 10 patent cases, right? And that's what they do. The truth is they might actually be very, very good cases. They might be very, very strong on liability. The damages might be incredibly high, and they might be legitimately good bets. Nevertheless, you'd have to say that those are equity bets, right? I mean, it's 10 patent cases. Those things can go to zero overnight, right? For a lot of different reasons. And so what you need is a firm that specializes in taking equity risk and pricing their returns accordingly, right? And there are a lot of firms out there that do that. That's not what we do. We'd rather see 1,000 cases, not 10. And we'd like to see them not in patents and stuff like that, which is very sort of binary in nature. We want to see tried and true mass torts, PI cases, things that we've seen 1,000 times before, that there's tremendous amounts of data on, where the cases are very similar to one another. That helps us hedge the risk on any individual type case outcome. If we're ever in a position where we're saying the investment thesis depends on this case or this section of cases really panning out, then that's probably not going to fit our buy box. It's really the opposite.
And the size of those companies, is there like something, an average? I mean, I know, I had a firm that sponsored our institutional investment conference because they do class action. And what the little I've learned is that, their colleagues don't like them. I mean, class action lawyers are pretty lonely people because, the big money comes if you represent Pfizer, right? And you're getting their fees. So the big guys, they are working with corporates, and the class action guys are usually are way smaller guys that are waiting for the class action to mess with Pfizer. But that firm, I think, they were pretty significant, hundreds of lawyers. I don't know if so. Is there? I mean, they're obviously smaller than the big guys because they are working with all the corporates, and you're dealing with a bunch of people that are willing to take the risk and fight the corporates, right? So corporate America is not crazy about them. But is there an average size in that world? Is class action legal firms is an example of somebody who would use your services?
So this is actually a really fun question. So let's unpack this. So
thank you.
I'll challenge only some of what you said, and then I'll expand on some of it. So in the class action world specifically, it is a very interesting world because you've got these sort of high flying guys oftentimes who will bring these big cases. But I can tell you that the payout on some of those cases can be very substantial, substantial enough that the guys who represent Pfizer are quite jealous of the paydays, right? on the ones where it actually hits big, right? Now, of course, the problem is that you don't win every time, and so there's a lot of risk to it, and that's why they're theoretically making the big bucks. So the question then becomes, what kind of platform do you need to be successful? And that kind of ties into what I was saying a moment ago, which is that you can't really do that kind of work at scale if you're just like a solo practitioner. So for us, the kind of law firm that would be a little bit more institutional grade would probably have at least like 10, 15 attorneys, potentially more, but at least that number, probably a small army of paralegals. Oftentimes those firms join together with other co-counsel and pool resources. And so the right elite level guys can be quite formidable. And that is one example of who we're lending to. We're also lending to, primarily actually, we're lending to firms that operate in what's called the mass tort space. In the mass tort space, it's a little bit different than class actions. The mass tort space is more like Roundup, right? Like, Monsanto, and then, Bayer, who owns Monsanto, has a product, and it turns out that the product may cause cancer. And so, thousands of people throughout the country have the same thing happen to them and the same injury. So if all those cases get filed, they get consolidated into what's called a mass tort. Then the name of the game in the mass torts racket is scale, right? So the way you get paid is by having a few Roundup cases prevail at trial where the bell is really rung, and then Bayer says, okay, we'd like to settle. And then you as a lawyer say, okay, great, I've got 1,000 Roundup cases, here's my inventory. And then they just write the check. Now it takes 3 or 4 years for that to happen, right? Which is why there's a lending need, but that's really the dynamic. So what kind of a firm has that type of platform? The answer is probably the same type of firm that I described a moment ago, but you can get away with less attorneys because it's more about intake and aggregation and less so with actually litigating the cases. So in the mass tort space, there are different sort of business models that you see all along the spectrum, all along the vertical. And what matters to us is whether the model makes sense and whether it's viable and whether there's a track record of that firm doing that thing.
And I want to ask you, as I mentioned earlier, there are very few that do what you do. And I've been here, for, I don't know, 15 years. How was this available? How new is this trend of doing what you do? I could have phrased it very, very easy, but somehow I don't. Like 20 years ago, class action legal firms had solutions like yours. What did they do back then? Is that a new thing that developed? Has it been around for a while?
Yeah, it's a good question. The industry has evolved dramatically in a very short period of time. I would say that 20 years ago, this industry didn't exist at all. I don't think that there was really anyone doing what we're doing or what other people are doing in any real shape or form, other than a one-off trade by a credit fund, perhaps, but there was no asset class whatsoever. Even, I would say, 15 or 12 years ago, it was the very nascent stages in that there was like 1 or 2 funds in the entire United States who did stuff. And if you were to take a poll of attorneys, have you heard about litigation financing? Would you ever do it? Like 90% of people like never heard of it, wouldn't touch it with a 10-foot pole. And if you were to poll most investors at that time too, they'd probably say, I don't really know what it is. And I also hate lawyers. So I don't really, get with it. So a lot has changed in the last 12 years. We got in about 5 years ago. So we were one of the first movers for our strategy. And now we've been around long enough to sort of see how the asset class has evolved. To bring it sort of full circle, it has over the last 8 years become a legitimate, it being litigation finance, has become a legitimate, institutionally recognized asset class. Investors, I think 5 years ago, were at the point where they were sort of curious. They like anecdotally, it seemed like people were making really good money and getting really good returns, but it seemed scary. It seemed new. ICs maybe were not familiar with the stuff, and so there were other niche investments that got the tip instead. I think we're in a different era now. We're now at the point where basically pension funds are investing in blind pool vehicles, endowments, foundations, fund of funds. I mean, all sorts of institutional investors that very, very careful and take a long time to do anything. Even they now are getting into it. And so, we've really kind of like gotten to a point where it's a true asset class. And, the competition has perhaps increased over the last couple of years, but from Kerberos's perspective, in the relatively narrow space or vertical that we operate in, we're continuing to do very well and continuing to get the same returns we always have, which is 20% plus gross returns, and taking very, very small credit risk from our perspective.
Joe, talk a little bit about the sourcing of the loans, how that process unfolds.
Yeah, so it's a combination of a couple different things. First and foremost, we source our stuff through, I would say, broker sell side relationships. The brokers on the sell side, specialize in like building relationships with the firms, and they bring us deal flow that has the benefit of effectively being pre-screened. So there are really two different sort of ways of thinking about origination. You could either have like the 1-800 number model where like, everyone knows who you are and the phone rings all day, but then 90% of it is junk. Or you could have the model that we have, which is we fly a little more under the radar, but the phone calls that we do get have a much higher hit rate. Or, in the case of sell side brokers, the stuff that they bring us, those guys know, the good ones that we work with know our buy box. They know what we like. They know what we don't like. And so the stuff that we see is presumptively facially within our buy box. And then whether it holds up or not is a different story. But, the opportunity funnel is a little bit different because of that dynamic. As we continue to scale and raise capital, that could shift a little bit more towards, direct outreach to law firms. We have a lot of proprietary and industry relationships, I would say, from my time as a lawyer years ago. I have a name in the space that some folks would recognize, and it's an advantage to us that a lawyer, a managing partner, or a plaintiff side lawyer could say, "Oh, this would be great. We can do business with someone who actually really knows our business because they live this and they breathed it," as opposed to a finance guy or a pure finance guy where there's a little bit more of a learning curve that can be frustrating for the law firm. So commercially, that's worked out really well for us.
Mm-hmm.
There's a question from someone here. Great topic. Do you cover other jurisdictions other than the US?
The answer is the counterparty will need to be US based because of the fact that if we have to sue someone, we don't want to have to go outside the US to do that. However, the collateral of that US counterparty could include cases in the UK, Europe. We've even had some firms that had like branch offices in Brazil, which is actually a very, very interesting place where there's a lot of exciting plaintiff side stuff going on because of the laws of that forum. But it's not like we have to go to Brazil to sue a Brazilian counterparty. I mean, it's still a US firm. So we are getting exposure to non-US collateral in part. But predominantly we're using the US collateral for the underwriting because we aren't purporting to be experts in like the legal system of every foreign jurisdiction that there is, right? Like, so it would have to be a situation where the loan is good because of the US collateral. And then it just so happens there's also some collateral in the UK that we're getting for free, which we can also, benefit from.
So, Joe, thank you for this. I wanted to ask Steve now that basically obviously works with you and distribute you. Steve, so what's the next step if somebody wants to get into the fund?
Yeah, so just to reiterate, AIR's strategy focus is through AIR Legal Finance Fund, and you can invest directly into the AIR Legal Finance Fund, which again really focuses through Kerberos on a strategy of law firm lending as opposed to single case lending and small portfolio lending. So the underlying collateral is highly diversified. There's cross collateralization within the borrowers, within the firms, and we have recourse to the law firms. So you can access that through AIR Legal Finance Fund. I'll give you a little background on it. It's about a year old. We have a 1-year track record. For the 1 year ending 12/31, we did about 14.25 net returns after fees. Minimum investments $250,000. The fee structure is 2 and 20, and we have a 6% hard hurdle rate tied to the return profile. Other things that may be of interest, withdrawals are quarterly upon 180-day notice. There is a lockup period of 2 years, which really does help us sort of match the asset and liability duration of the underlying investments. But yeah, you can reach out at info@airassetmanagement.com. I guess Denny will provide our contact points. You can reach out to anyone at AIR through airassetmanagement.com or my contact points, and we could provide further information such as a fact sheet, presentation material, and any of the items necessary for an investor to do their due diligence.
Great. So thank you for that, Steve. I know Steve for quite a while. We met in Connecticut at an OK restaurant, and Joe. Yeah, it's very exciting what you do. I was very impressed. We spoke before as well. I will tell our audience here that I'm in Chicago, which is your hometown, and where actually our asset is based. So it's fun. I'm here at the Peninsula Hotel today, and I just want to tell you that we've done our first conference in Chicago in October, and I was very impressed to say that from Crown, Pritzker, Zell, Ricketts, Duchancel, I suck at French, but I think that's the name, and Carol Levin-Bernick that sold Alberta Culver to Unilever. Everybody were here. We were either on stage or off stage. We love Chicago. I even discovered here your how do you call it, the field pizza thing that is actually a combination of pizza and soup, which was very interesting. So we have a ball here. I'm now here in Chicago because we're working on our next conference in September with exciting speakers that's going to be there. Just to mention to everybody what's coming up next month, which is March. 2 conferences in Houston and Dallas, March 20th, March 22nd. Amazing speakers from Metros Mac to the owners of TGI Fridays and the next gen of 7-Eleven. Amazing people. And then on the 29th, the following week, New York City, our flagship conference, the Union League Club, which happens to be, for all of you that keeps on telling me if somehow we have too many males at our event, where are the women? All the keynote speakers this year at the New York conference are women. Men will feel very lonely at our conference this year. So I welcome you all to join us. We have a private dinner next week in New York City as well, and around Houston and in Houston around the conference as well. So all of you that wants more information, just let us know. And yes, Steve, always fun to see you. Joe, I hope we'll manage to meet while in Chicago. This will be on by tomorrow at the same time. You all will receive the link to this recording, including those of you who haven't been here, who don't know that yet, but you'll know tomorrow that you will have the recording. So thank you. Steve and Joe, anything else you'd like to add?
Nothing to add. Thanks very much for including me. It was fun.
Yeah, thanks for the opportunity, Denny. Joe, thank you so much as always. Look forward to seeing you soon.
Got it. Thanks, Steve.
Thank you, guys. And
All
thank
right.
you, everybody, for being with us today, and enjoy the upcoming weekend, everybody.
Okay.
Thank you.
All right, thanks, everyone. Bye-bye.
Bye-bye.